Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to look at some similarities between oil and the 10-year yield. We're getting a little divergence going on here recently, and they are usually pretty well linked over time. It the magnitudes may be different, obviously, but the way that they move, the up and down movements, are closely linked together. So when oil goes up or when the 10-year yield goes up, they're linked to some degree. If the if there is a linkage, and the linkage is pretty tight, and I'm going to show that here, the Federal Reserve is going to raise interest rates, and I'm sure the markets will raise with it. But a couple of things to ponder here. A couple of things to ponder. We are actively trying to suppress the price of oil. That's what the Strategic Petroleum Reserve release is around the world. We're doing it in the United States. There's other international energy agencies doing it. They've got some as well. And we've been releasing oil to the markets to basically suppress the price of oil. Now, there could be things in the mix that also are out there that maybe, it's war related with Russia and China and all these things. I'm seeing these shutdowns with not many cases. What I mean by that, it's the medical event, the COVID cases. There's not many cases in China, but they're locking everything down. And if you look to see where the lockdowns are happening, they're happening in some of their larger manufacturing cities. What that could potentially do is I know I'll eventually lead to where I'm getting, but it'll slow down the inputs for GDP for America. So if they slow everything down in those areas that have all the manufacturing, that's the inputs for stuff later on in America. And if you've printed a bunch of money at the bottom of 2020, it's in the system, and oil and the 10-year yield and yields are tied to oil. What you could do in a financial kind of war game, and again, guys, I'm just speaking freely here, kind of throwing it out, is what you want to do is you want to choke your inputs to your enemy, so to speak. You choke the inputs, you get them to create a bunch of money, or do it during a time frame where there's a lot of money in the system, and then you hit oil, because oil is very linked to the 10-year yield. And I'm going to show you the linkage there. What could be coming after the Strategic Petroleum Reserves is, and this is how you would do it. I'm going to back up 1 second and describe something too. Russia went to war with but we don't necessarily know who they're going to war against. They very well could have went to war against Ukraine, but it's probably deeper than that. I do know that the ramifications or the outcomes of that was a bunch of sanctions on oil. And those sanctions delinked what they sold oil against the dollar. They delinked it. They're not selling oil for dollars anymore. And they're selling their energy for rubles. And if someone had done that without going to war, without those sanctions, without all those things, well, most likely we would have gone to war with them. There was other countries that have tried to do that, and we were very strict with them not doing that. Egypt, I think, was trying to do that. Saudi Arabia or Iraq was trying to do that too, with where we found weapons of mass destruction. But if you look, they were trying to trade oil for gold and other currencies and whatnot. That would be Saddam Hussein. But looking at some of this stuff, it's getting a little bit weird because a lot of that oil is finding its way to China. A lot of it's finding it to India, and there's getting some alliances over there. What you could do is you could have a country that is vastly in debt. And if oil, I'll go into it right now. If oil's tied to the 10-year yield, so this is XOP. I'm just going to throw a couple of comparisons up here. One comparison is crude oil. And crude oil, obviously, there is a linkage here. You can obviously see the ups and down movements. Crude oil and XOP are very closely related. Now, if I were to throw on the 10-year yield, TNX, and throw it on there, well, look at that. That is also very linked to oil. We kind of move this in and out to show you guys kind of the linkage and what it looks like between all these three. But there is that linkage between them. They're highly correlated. So they're linked to some degree. And we know that we're short on oil, that we're trying to suppress the price of oil. When those inventories run out, could something, like Russia or somebody use oil as a weapon? They've already cut their natural gas to Europe. And perhaps they're using it as a weapon against them. So when you look at this stuff, and I know it's I'm just looking at it from a financial thing. I don't really, read a bunch of the politics type stuff. I'm just trying to piece some things together. Maybe it's right, maybe it's wrong, but they could come out using oil as, a weapon and then not sell it to the markets, driving energy prices much higher. Energy prices are related to the 10-year yield. And I don't know if these governments can really be successful even doing a bunch of QE. I mean, they do have unlimited amounts of money, but it would be highly inflationary on top of it to hold the rates down. Inflation, by the way, we measure it is through the consumer price index. The consumer price index has these items in it. It's a way that they basically created this system to manipulate inflation. Inflation is just the increase in the money supply, but they manipulate it through using the consumer price index. But the consumer price index can't really get around a large commodity increase. And I know in the short term, people are afraid of a recession. They're afraid of disinflation. They're afraid of all these things. And that's great for bringing inflation down. But these things can be used as weapons, though, in terms of not selling energy to the markets like natural gas. They could do something with oil, and things could get pretty hairy. So there is ways that you may want to think about protecting yourself, like physical metals and stuff like that, because currencies, they don't do very well in an environment where if oil prices were to rocket a lot higher based off of war or whatever, that the 10-year yield could also shoot up with it, because the markets are not going to take a gigantic real negative return in bonds, so that you're going to be selling bonds in mass. Then your interest rates go up. But if you have a high debt country, those interest rates could heavily impact the countries that have high debts and make it basically a non-sustaining event. So the way that I have viewed this with when the debt gets way up there is I play my ratio games with precious metals and I'm out of the system, protected against anything like a potential threat like that. And again, if the dollar is going to have problems out in the future, it'd be nice to have a hedge against it. And again, if it loses a large amount of value, and I'm not saying that this is necessarily going to happen. I'm just saying it's potential. You may need to find ways around it so to protect yourself. But there could be that game going on, and perhaps perhaps the attack is really against the dollar or the currency, and that is why some of our response is to basically strengthen the currency as quickly as possible. And that is the struggle between these areas. And maybe you'll see very large rate hikes, and maybe the S&P 500 will be sacrificed for the dollar. And then you could see other retaliation moves. Again, there was the medical event in 2019. That event is we had shutdowns. We printed lots of money. They probably figured that was going to be a response. And then they're continuing to do lockdowns over in China to basically stranglehold the supply chain of a bunch of things, I think. They're not having a lot of deaths. They're not having a lot of like outbreaks. So I don't see. I'm just trying to like figure out, why would they be doing this? And I'm just saying maybe that's what they're trying to do. I don't know. But shrink your supply chain or slow it down. Use it as a weapon. That'll get you inflation in consumer price index numbers. Then you choke the energy, and they're already choking it over in Europe. And they're forcing people to use currencies outside of the dollar. That right there is considered to be a blow, and they're going for it. And they're aligning themselves with India and China and very large countries. Commodities come from Russia, a lot of them, and then you've got China with their manufacturing. So if you don't manufacture anything, or you don't manufacture a lot, and you've got lots of debt, and you use oil as a weapon, and oil is highly linked to the 10-year yields and interest rates, that will force inflation higher, and it'll pull those interest rates higher with it, and it puts the country in large debt into a problem. So that's just one thing I kind of wanted to talk about, some things I was thinking about. And with the 10-year yield, if we were to look at this real quick, for the 10-year yield, let me get this out of here. The 10-year yield has been moving higher. We're at this basic pause point right at this resistance level. Sometimes they pause there before breaking higher. And I mean, we'll see if we break here. This is on the daily candlesticks. We do have some nice momentum. We're right at that support line, and we'll see what happens. We have been doing strategic petroleum reserve releases. We happened to have a LNG terminal go down, lowering our natural gas prices. That was probably just a fluke, And gold, silver, and platinum must be controlled because those are signals to the market that something is wrong if they take off. We have not seen a large decline in physical metals. The premiums remain robust, and a lot of people are taking physical. That is what I'm doing. I'm taking physical, some of my money, buying physical, and continuing to buy it and pile into it. Even gold looks good here because gold is money. It does very well in times of fear of currencies. So, I'm looking at this stuff maybe from a different paradigm, from a little bit different outlook than some other people. And I don't view short-term ups and downs as huge deals. I'm positioning for what potentially could happen. And I'm not doing it from a politics perspective. I'm doing it because it's all in alignment. And if this gets out of control, where oil gets taken off the market from Russia, if there's currency wars going on that are involved, the physical metals, I think, will do quite well. But it's going to be basically doing nothing, 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 and then a whole bunch of something happens all at once. I think that's kind of what's going to happen. It's going to be like a flood of money that comes at it, much like the 1970s. It'll be like nothing, 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 and then boom, explosion. These market conditions are positive for currencies to go, or for money, real money, precious metals. Currencies go down, precious metals go up, just like the 1970s. Energy crisis is in front of us, higher interest rates. We could have a paradigm, a 40-year downtrend break in bonds. That money's got to go somewhere. That money has to go somewhere, and some of that money could leak over into these things. So I think the market conditions are set, and I think that there's catalysts out there that may or may not be in play. And I don't know if necessarily we're going to have a recession. There's a lot of fear around it, and maybe we do. But that is an outcome of being short in energy. I do not think that we're going to be growing massively, or Germany or some of these countries that have extremely high energy costs. Energy will continue to drive the PPI and CPI higher. If you look at Germany's PPI and CPI, it is rocketing higher. That could be a test bed for what's coming. A lot of things have changed. It was about renewable energy and about green measures. Now, if you look, they're changing their rhetoric to security. And I have heard about presidents earlier talking about going to renewables to de-link against oil and other energies that are needed for security reasons. So I'm just kind of talking this through. Again, I'm not an expert in politics. I'm just kind of tying this stuff together of what could potentially happen. But alliances are being made. They're selling things in different currencies than the dollar. Things are changing. And I know back in the day, people who sold things in commodities, if they sold commodities outside of the dollar, we would go to war with them. And perhaps it's already underway. That's all I'm saying. And that war is not necessarily Ukraine. That's just a pawn in the game. It's a pawn in the game. So I think about that stuff. That's why I have such a heavy loading in precious metals, because the risks are a lot lower there. That's why I created the game that I call it the game of ratio investing with using precious metals and swapping between metals over time. That means that it does not matter if the portfolio is exposed to inflation, deflation, doesn't matter. I'm just accumulating my ounces of whatever precious metals it is and continue to accumulate more and more and more. And then eventually, if we're in an inflationary system, that will be priced higher in dollars eventually. And the dollar value doesn't even matter. As long as you're accumulating more precious metals that are produced or taken from the ground at a slower rate than mass production, you can buy more of those mass-produced things than what those precious metals have. So you could buy more and more of other items that you want or need because they're being manufactured at a faster pace than the precious metals. So it's a low-risk way to preserve wealth and grow wealth through ratios using just precious metals, all the precious metals. But it's something I wanted to talk about. Hopefully you guys like the clip. Definitely put comments on what you guys think or what your thoughts are on the subject. And if you want to become a platinum member, description link below, definitely sign up. You can see everything that I own. I've got some natural gas companies that have my eye, a couple of oil companies as well. And I'm thinking, a little bit of sprinkling's fine. That's kind of what I'm going to do. I'm not afraid, but when we get below certain levels, over 30% declines in things, I start just sprinkling no matter what. That's kind of my strategy. I don't really, I try to time it as best as I can. If I see any sort of strength, we're out of the support zone or something, I sprinkle a little bit in and I keep going. Some of the positions that I've made recently, they are down. They're down 40, 50% on some of them. Some of these ones, I didn't think they'd pull back that far, but that's where we're at. Other positions are still up quite a bit because I bought quite a long time ago. So I'm going to continue to cost average in. That's the strategy. And I know people get so hung up on their market values going up and down. It's part of the game. If you want to be participating in this game, you're going to have to learn to take those shots. And you got to keep looking at the market conditions, keep looking at the ratios, and as long as it's cheap and as long as the market conditions are favorable, I will continue to purchase in those equities that I like. So that's what I've got for today, guys. We'll catch you next time. This is Finding Value.